All right. Welcome to our channel. Welcome back. This is Jeremiah with annuityassociation.com. And we are back for another exciting annuity review. Lots changed since the last time we put one out. A lot of good change. We've been helping clients all over the country. Really fortunate and blessed to have this opportunity to extend our reach and help people make better annuity buying decisions. That's what our mission is. And we now have an entire team of advisors that understand the right way and appropriate way to apply annuities to people's retirement planning. And we do so in an objective basis in regards to identifying the best interest and objectives of each individual client, and then ensuring that the annuities that we're presenting obviously meet those objectives first. In addition, what's unique about our operation is that we also really ultimately strive to help you as a consumer make better annuity buying decisions. And we do that through transparency and education. So if you're in the market for an annuity and you want to make a better annuity buying decision where you're not feeling like you're being sold something, but rather being educated on how each particular annuity works and how it meets your defined objectives, and you more importantly want a way to identify and compare side by side the hundreds of different annuities on the market today, then somewhere around this video you can click a link or go to our website at annuityassociation.com, and right there on the main page you can request a no obligation, hassle-free annuity discovery meeting with my team of advisors, and we'll connect and see if we can help point you in the right direction. So without further ado, we are going to get right into a handy dandy review. Before we do, let's go ahead and share my screen, and I will read our quick and brief disclaimer. So today we are going to be reviewing the Equitrust Market 7 Index Annuity. And this has been a very popular one as of late. It has been very competitive on the marketplace. So that's the one we will be discussing today. So again, Equitrust Life Insurance Company, the Market 7 Index Annuity. This is a fixed indexed annuity and an independent review brought to you by yours truly, annuityassociation.com. This is a review, not a recommendation to buy or sell an annuity. Equitrust does not endorse this review in any way, nor do we receive any compensation for this review. This review is meant to be an independent review at the request of website visitors so they can see our perspective when breaking down the positives and negatives of this particular annuity. Before purchasing any investment product, be sure to do your own due diligence and consult a properly licensed professional should you have specific questions as they relate to your individual circumstances. All names, marks, and materials used for this review are property of their respective owners and not that of annuityassociation.com. While care has been made to ensure this review is complete and accurate, no guarantees are made to the completeness or accuracy. All right, so if this is the first time you're tuning into a review, thank you for tuning in. And if you are wondering what this review is going to contain, it's very simple. We go through an overview, an in-depth overview, very detailed and specific, by covering the nuances of each individual product. We're going to dive into the product brochure, go through all of the verbiage, terms and conditions, and features and benefits of the brochure, and then we will get into our software that we utilize to help clients make better annuity buying decisions. And that software is designed to take an in-depth look at the specific rates, features, how it may compare to other annuities, and we'll even be delving into the specific index crediting strategies so that you can compare those index crediting strategies to see which ones may perform better than others. The one thing we find is that not all indexes are created equal. Some perform better than others, and our mission is to help you identify those differences so that you can make a strong and confident and wise decision because you have the understanding, the education, and the transparency. So let's go ahead and get into the brochure. Bear with me here. Let me share my screen. And again, we're reviewing the Equitrust Market 7 Index Annuity. This is a fixed indexed annuity geared toward helping you accumulate retirement assets, as well as building income to achieve your future goals with the advantages of index-linked performance and downside protections. So throughout your working years, retirement may have seemed like a lifetime away. Now it's closer than ever, and you're likely adding plenty of plans to your bucket list to bring you wishes to life. You'll need to boost your future income and protect what you've built. At Equitrust, they know how important your goals for retirement are, and that's why they offer a 7-year fixed indexed annuity to help you achieve them, which they refer to as the Market 7 Index Annuity. So how does a fixed indexed annuity work? A fixed indexed annuity like the Market 7 Index is a product designed to provide you income for retirement through interest earned on market indices. Your money is never exposed to downside market risk. In fact, you share only in the gains, not the losses. So if you're new to fixed indexed annuities, one of the unique features of these types of products is that you have a contractual guarantee of principal protection. Your money cannot be lost to the downside risk of the markets. So when it comes to growing your accumulation value, it starts by choosing your index accounts and crediting strategies, providing you the ability to diversify your retirement strategy. Then, on appropriate contract anniversaries, index credits are determined on these accounts and applied to your contract's current accumulation value. If the index value increases, your accumulation value grows. If the index value declines, your accumulation value will simply remain unchanged from the previous period's accumulation value. Index credits will never be less than zero. So here's a quick chart just as an example of how those mechanics will work. If the index is growing in a positive manner, then you'll see that that correlates to the accumulation value growing as well. And then if the index declines during any specific crediting period, the accumulation value remains unchanged. There's a saying in our business where zero is your hero. That's referencing the benefits of the contract of principal protection, so that in the event the markets are down or the index is down, your accumulation value remains unchanged. And the worst you could ever do in a given crediting period or annual or biannual period would be a zero credit. So some of the advantages of the Market 7 bonus index: your fixed indexed annuity contract is backed by the claims paying ability of the insurance company Equitrust. Fixed indexed annuities offer several important advantages. Some of those are protection of your principal, again, a contractual guarantee from downside risk to the markets, tax deferred earnings, built-in guarantees such as lifetime income guarantees, withdrawal privileges, and guaranteed lifetime income with the optional income benefit rider. You control your money coming in or going out. The Market 7 Index puts you in the driver's seat with flexibility and options that give you control over your money. So premiums are referred to as your initial premium payments or investment amounts. You may add subsequent premiums at any time, and you may allocate your premiums to the fixed rate account or index accounts. The fixed rate account that's offered is a 1-year renewable interest account. The interest rate is guaranteed for 1 contract year and may change subject to contractual minimum guaranteed interest rates on each contract anniversary. Subsequent premiums are applied to this account until contract anniversary, then allocated per instructions. For the various index accounts, there are a variety of those that you can choose from, and they can offer earnings called index credits based on the changes of a specified index. Credits are never less than zero and are added to accounts at the end of the 1-year or 2-year period. Cap and participation rates are reset annually or every 2 years, depending on the specific crediting term. So this is an inside look at the available account options. Later on in this review, we will take a look at our software, which will identify the various index crediting strategies and then take them through a hypothetical back test of how they may have performed over the last 10, 15, and 20-year periods. So we have a 1-year point-to-point cap strategy that's following the S&P 500 index. There's also a 1-year monthly average cap, again, with the S&P 500 index, and then a one-year monthly average participation also following the S&P 500 index. Now, if you're not familiar with any of these terms, very simple. A 1 year is referencing the specific crediting period. So if it's a 1 year crediting period, it's monitoring a 1 year period of time, obviously. And then if it's a 2 year, it's monitoring a 2 year period of time. And the point to point is a very simple terminology that's used to reference the starting point and the ending point of the index. So on the issue date of the policy, if the index that you choose has a specific value on that day, you'll have that specific value for that starting point. And then fast forward to a year in advance on that anniversary, the ending point would be the ending value of that index. If there's positive performance for that 1 year period, meaning the ending value of that index is higher on the 1 year anniversary date than where it started on the issue date, then that means there's positive growth. And depending on that growth, if there's a cap, then the cap specifies how much of that index's growth can you earn up to that cap. So if there's a 10% cap, the index was up 11%, then you would have earned 10% max, since there's a cap of 10%. In another example, if there was a 5% growth of that index and you have a 10% cap, you would earn all 5%, since it did not exceed the 10% cap. Hope that makes sense. Monthly averages and monthly average participations, those are a little bit different in how they work. So there's actually a 1 year period in this case, but each month's performance of that index and the change of that index is being calculated. That then goes into the 12-month calculation. So if it's a cap, that means each month there's a cap associated with that monthly crediting. So sometimes those caps will be 2%, let's say. So you could have, if you had all 12 months for that 1 year, and that index was just going up at a rapid rate, and you're hitting that 2% cap each month, then in reality, you could have up to a 24% credit of interest at the end of that 1 year period. One of the unique things, though, to understand about the monthly averaging is that negative performances are calculated as well in those, in most cases. So if you had 1 month where the index was down 2%, and then the next month it was up 2%, your average for those 2 months would be 0. So the zeros the negative performances do go into the calculation. However, if the full 12-month average was negative, then you would just earn a 0 for that full 1 year of crediting. Okay. In regards to the 1 year monthly average participation is a term used in an annuity that defines of the index's performance, how much do you participate in? So if the index was up 10% over that 1 year period and you had a 50% participation, the math would be 10% raw performance of the index multiplied by the 50% participation. In that example, your net interest credit that would be applied to your contract would be 5%. So there's a lot of different strategies involved in here. I don't have a lot of time to cover each individual one, but we will look into the back-tested performances here later on so that you can get a much closer look at what those growth opportunities may be. Inside the Market 7 Index Annuity, they do offer the traditional S&P 500 index. They also offer some different variations of that index, the one being the S&P Mark 5% Excess Return Index. The Mark stands for Multi-Asset Risk Controlled Index. So it's an algorithmic-based index that's using rules to determine how it rebalances given the level of volatility of the S&P 500 and other asset classes that comprise it. There's the Focus 50 Index, and that rounds out those index options. So some of the other important features of the Market 7 Index offered by Equitrust are account transfers. On each contract anniversary, you may transfer money among the various accounts offered in your contract. transfers out of a 2-year account are allowed only at the end of each 2-year period. So if you become a client of Annuity Association, we meet with you every crediting anniversary to help you understand the performances of your annuity and then help you make an educated decision on whether or not you should change the index allocations, or maybe you even consider going into the fixed account depending on the different market environments that we might be in at that time. But that's all part of our service, our client experience. If you become a client, we will meet with you every year. We call that our annuity assurance program for our clients. In regards to allocation of additional premiums, at any time you can request a change to your premium allocations, and these updates do take effect on the following contract anniversary and apply only to any additional contributions during the contract year, current contract year. You do have free withdrawal provisions in this annuity, up to 10% of the accumulation value each year, and after the first contract year without paying any charges. So every year you can access up to 10% of the accumulation value with no penalty. So if you need additional liquidity, maybe you need to purchase something and you have this account value or accumulation value that you can access up to 10% with no surrender penalties being incurred for that withdrawal. You also have lump sum payment options. Your contract's cash surrender value is available as a lump sum at any time, and those surrender charges are in effect during the first 7 contract years as a percentage of the accumulation value, and those decline annually, starting at 9% the first year, 8% the second, 7% the third, so on and so forth here, 6.5%, 5.5%, 4.5%, and then finally 3.5% in the 7th year. After 7 full years, you can withdraw the full account value or accumulation value with no penalties incurred whatsoever. If you do have a lifetime income rider, though, that would be foregone in the event you did surrender. The value of tax deferral. All annuities are tax deferred vehicles. So currently all interest income earned on an annuity accumulates on a tax deferred basis. You won't need to pay income taxes on your annuity until you receive a payment from your contract. If you're under 59.5 at the time of withdrawal, there may be an additional 10% IRS penalty. So Equitrust, who are they? It's a name that you can trust. At Equitrust, they're committed to being a financial partner you can trust with your retirement dreams. Rest assured, your annuity contract is backed by a company with conservative investment strategies, anchored by a disciplined and diversified management style. Equitrust is supported by a history of success, experience, and strength. Magic Johnson Enterprises, a diversified consortium of business entities and partnership, owns a controlling interest in Equitrust. So part of the annuity discovery process that we offer our clients and prospective clients at Annuity Association is a deeper dive into the specific insurance companies. We'll take a look at things such as the financial stability ratings and what those mean, how large of a company these organizations are from a sheer size or management of assets perspective. We'll look at the original commencement date to see how long that insurance company has been operating. And in addition, we'll take a deeper dive into the balance sheets of these companies. We'll look at their assets and liabilities and capital surplus, as well as, what their actual investment holdings are in, so that we can determine whether or not there's any levels of risk associated with how they invest their money. We'll look at their track record of net incomes over the last few years, and we'll also look at their client complaints on a national level. So if you're interested in comparing companies, not just the specific products, to ensure that you make a better annuity buying decision, you can go to our website to work with us directly, annuityassociation.com, and right there on the main page, you can request to meet with an advisor. It'll take you to our calendar where you can schedule a meeting time that works best for you, so that we can connect via Zoom and help you make a better informed decision. So guarantees around the accumulation value benefit. At the end of the year 7, your accumulation value is guaranteed to be no less than 107% of your premiums, less any partial withdrawals and income benefit rider fees. So what's that mean exactly? They're stating that in the rare event that the indexes were to provide 0 interest credits over the entire 7-year surrender period, which is the contract term, they would give you at least 107% credited to your premiums, less any withdrawals and income benefit rider charges. So essentially 1% guaranteed on your money each year in the rare event that the indexes were never to perform whatsoever. In addition, there are minimum contract guarantees. You're guaranteed to receive no less than 87.5% of your premiums, less than any partial withdrawals accumulated at the minimum guaranteed contract rate. So what that's referring to is, in the event you decided to surrender your policy during the 7-year contract period, the minimum guarantee means the least you could get out of the contract based on your premium investment that you put in would be no less than 87.5%. That would include your surrender penalties and any applicable market value adjustments. The Equitrust Market 7 Index also includes a nursing home waiver that's included at no charge on your contract and can help provide you peace of mind. If you're confined to a nursing home or hospital for 90 consecutive days or more, your contract's accumulation value will be available without surrender charges or market value adjustments beginning in the 2nd contract year and during your confinement. This rider is available at issue through age 80. There's also a terminal illness rider where there's no charge as well, and it can provide assurance that if you're diagnosed with a terminal illness, charges will be waived for withdrawal of up to 75% of your contract's accumulation value. Obviously, outside of that 7-year window of time, you can access 100% of the accumulation value with no penalties for any reason. And there's also a death benefit. One of the biggest misconceptions of annuities, and one of the things we often hear with new prospective clients, is that they hear all the time that if you buy an annuity, the insurance company keeps your money if you die. And that is the biggest piece of misinformation around annuities. There's actually only one type of annuity structured in one particular way that would ever occur. But in a fixed indexed annuity like this one, offered by Equitrust, there is a death benefit in the event you die. And the death benefit is the full accumulation value of your contract that would be paid to your designated beneficiaries without any surrender charges or market value adjustments. So in the event you pass away, even during the first 7 years of the contract, the full accumulation value would pass on to your heirs or charities. And then, of course, all annuities have a free look period after your contract is issued. You have a specified number of days to review it, and you can see your contract for complete details. If you're not completely satisfied with the terms, you may return the contract and receive 100% of your premiums paid minus any prior withdrawals. So all states require annuity companies to offer this free look period, and it does vary state to state, but it gives you peace of mind knowing that, if you have concerns that it's not the right contract for you, you can return it within that specified period of time and get a full refund. So let's talk about the guaranteed lifetime income that the Market 7 Index Annuity by Equitrust offers. They refer to this as the income benefit rider. Rider is just a fancy word for a feature or option that you can add to the contract. It's something that's going to offer you very important benefits. And one of the main reasons people buy annuities is for that guaranteed lifetime income. So within this specific rider, the lifetime income is going to be based on a 7% accumulation plus index and interest credits for up to 7 years. So with this product, they're basically stating a guaranteed rate of how that income benefit grows during the deferral period. You can defer each year up to 7 years and receive that guaranteed 7% interest rate that's applied to the income benefit. In addition, a 25% bonus is added to your benefit base for premiums paid in the first year. A guaranteed stream of income for life, and this is the key of understanding the income rider, and the benefit that it offers is that you are not having to annuitize the account's value in order to receive this guaranteed stream of income for life. So annuitizing is the term that's used when you are giving up complete control over the principal investment in exchange for that lifetime income guarantee. In an indexed annuity with a lifetime income rider, you are not annuitizing the account value in exchange for that lifetime income. So in other words, you maintain control over your principal investment plus any interest that's been earned from the various index crediting strategies. So you have peace of mind that you have this guarantee of income that you'll never outlive. And in addition, you have this account value that you maintain control over so that you have a lot of flexibility and optionality as you move to and through retirement, that if your needs change, you can, access those funds by leveraging the free withdrawal or fully surrender the contract and move on if you decide to. So another misconception about annuities is that you give up control over the principal in exchange for that lifetime guarantee. That is entirely false. Again, only one annuity type structured in one particular way that would ever even be a scenario. But in this case, with this type of annuity being a fixed indexed annuity with a lifetime income rider, you are not annuitizing the principal account. You also have the ability to double your income for up to 5 years in the event of a chronic illness. So if you have a need for long-term or confined care and you're unable to perform 2 out of the 6 activities of daily living, the contract states that you can receive a doubled amount of income for up to 5 years. So whatever that guaranteed minimum lifetime income is, if you qualify for this chronic illness doubler, then the income will double contractually and pay that doubled amount for up to 5 years. After 5 years, the amount of income will revert back to the original guaranteed amount. So another feature or benefit that can help you as you age in retirement. Flexibility and control to start and stop income payments when it works for you. So you always have the ability to stop the income payments once you start them. So in the event that you don't need income for any particular period of time, you have the flexibility to stop those withdrawals and then reactivate them at a later time. All of this while maintaining all of the other annuity benefits. At any time after the first contract year and you're at least age 50, you can elect to begin these lifetime income withdrawals. Your payments will never decrease if you withdraw only your income amount each year. In certain situations, your payments may increase as well. So how do you qualify for the income benefit rider? The owner of the annuity must be age 40 or older to elect the income benefit rider, and it can be added only during the annuity application process. To qualify, the owner and annuitant must be the same person, and joint owners must be spouses. Spouse may include domestic partners in some cases, but does not include spousal continuation. So calculating the income withdrawal amounts, your payments may be will be calculated based on this equation. It's the income withdrawal percentage multiplied by the income benefit base amount, and that equals your income withdrawal amount. We'll take a look at that here in just a moment when we get into the software to see, what those numbers attribute to and are attributed to, and then how to understand the calculation further. On your contract anniversary, your income withdrawal amount will be recalculated as the greater of the prior year's income withdrawal amount or the original income withdrawal percentage multiplied by the current benefit base. So when you buy an income benefit rider like this, you're essentially buying a contract that states how that income benefit grows during the deferral phase, or in other words, while you're waiting to turn on the income. It'll include in the contract any applicable bonuses to the income benefit, how that income benefit value grows each year of deferral. And then in addition, you'll have in that contract the payout percentages, or what they're referring to as withdrawal percentages, at the time of income election. So the longer you wait or the older you age, in most cases, the withdrawal percentage will be higher. So the income withdrawal percentage is based on your age at the time you first elect to receive income withdrawals, and it increases by 10 basis points each age between the ages shown below. Once income withdrawals start, the percentage will never change. So once you activate the income benefit, the payout percentage or withdrawal percentage will be based at the time of income election, so whatever age you are at that time, and that'll be locked in permanently moving forward. So even if you pause the income later and advance in age, the income amount will never change. It'll stay right where it was because that payout percentage will remain the same, which was determined on the date you elected the income to start. So there is different payout percentages for single life or joint life structure. And it does change each year. So right now on this chart, they're just showing every 5 years, but each individual year in between, the payout percentage goes up by 10 basis points. So if you were 51, it would be 5.6% for single life or 4.6% for joint. If you were 52, it would be 5.7 or 4.7 respectively, so on and so forth. Your annuity's benefit base is equal to all premiums plus a 25% benefit base bonus on your first year premiums paid, less any withdrawals, and compounded at 7% annually for up to 7 years, or until you start your income withdrawals if earlier. And they use the benefit base only to calculate the income withdrawal amount. It's not available at surrender, death, or any sort of annuitization. After you start income withdrawals, the benefit base will be set equal to the accumulation value on each subsequent contract anniversary, if the accumulation value is higher. This means income withdrawal amounts can potentially increase from year to year. So what they're saying there is that the benefit base is going to grow guaranteed with that 25% bonus and that 7% roll-up rate each year of deferral. And that benefit base will be set to those minimums. Now, in addition, they're going to look at the accumulation value on each anniversary. And if the accumulation value is higher than the benefit base because the indexes and the index crediting strategies outperform those minimums in the benefit base, then they will upgrade the benefit base to reflect the higher accumulation value, which means that potentially that income could increase. So that's a nice feature to have, and not all indexed annuities with lifetime income riders provide that as an option. So very unique feature there, that the incomes can potentially increase if the accumulation value exceeds the income benefit base. Additional premiums, the benefit base will increase with any additional premiums and will reflect a 25% bonus for all first year premiums paid. You may not add premiums after you begin income withdrawals. Now, flexible income withdrawals can start, you can start income withdrawals at any time after the first contract year and age 50 for both owners. Unlike annuitizing your contract, the income benefit rider gives you the flexibility to stop and restart income withdrawals when you choose. And those payments continue for life, even if your contract's accumulation value is depleted. So in the event that the accumulation value is reduced to zero after you start income withdrawals, that's where that contractual guarantee of lifetime income comes into play. And right here on the brochure, it does state that the payments continue for life, even if your contract's value is depleted to zero. So you have peace of mind that in the event you had unfavorable sequence of returns, maybe the indexes didn't perform well at all, and then you started income withdrawals that then start to deduct or reduce that accumulation value. Even in the event that it's depleted to zero, the lifetime income will continue to pay, and it will continue to pay unchanged. It will never reduce unless you took out additional free withdrawals on top of those income payments, which then obviously it would deplete or reduce the income benefit payment. Income withdrawals may be taken monthly, quarterly, semi-annually, or annually. After they start, the annual penalty-free withdrawal amount is the greater of 10% of the accumulation value or your income withdrawal, whichever is greater. Excess withdrawals. So it is possible to withdraw more than your income withdrawal at any time, but it will reduce your future income withdrawals permanently. Any amount withdrawn in addition to your income withdrawal is considered an excess withdrawal, and with the exception of a required minimum distribution. If the excess withdrawal amount exceeds the penalty-free provisions of the contract, it may be subject to a surrender charge or market value adjustment. Excess withdrawals reduce future income withdrawals in the benefit base in proportion to the reduction of the accumulation value. So waiting can boost your income. Starting income withdrawals later can significantly increase your income over the remaining years, as shown here in this chart. So what they're doing is showing you an example of a $100,000 premium investment going into the contract. The issue ages on a 5-year scale. And then they're showing you if you waited 1 year, what that income would be for each of those ages, and versus if you waited 5 years to start income and 10 years to start income. So because of the guarantees, the 25% bonus and the 7% roll-up rate that's applied to the income benefit base value each year of deferral, and lastly, that withdrawal percentage increasing as you age, when you factor all of those in, the incomes are higher the longer you wait. If you stop income withdrawals, you have the option to stop income withdrawals at any time. While the payments are stopped, partial withdrawals in excess of the income withdrawal amount will be considered excess withdrawals and still reduce your future income withdrawal amount. If you decide to restart income withdrawals, the income withdrawal amount will be the greater of the prior income withdrawal amount, adjusted for any excess withdrawals, or the original income withdrawal percentage multiplied by the current benefit base. There is a fee for the income benefit rider. In this case, the annual rider fee is 1.25% of your accumulation value, which is in line with the industry average. Generally, that range is from 1 to 1.35% on average. This fee is deducted proportionately from each crediting account for the accumulation value. So let's dive in a little bit more on the enhanced income withdrawals during the chronic illness qualification. It's no secret the cost of nursing care later in life could have a big impact on your retirement savings, and to help you prepare for those potential expenses, the income benefit rider features enhanced income withdrawals included at no additional cost. So if you become chronically ill, your income withdrawal amounts may be doubled for up to 5 years. And if you're having a joint owner structure, the increase is 50%. So it's 100% or doubled for the single life structure, and a 50% increase for joint structure. A chronic illness is defined as the permanent inability to perform at least 2 of 6 activities of daily living, which include eating, toileting, transferring, bathing, dressing, and continence, or permanent cognitive impairment. If utilized, the original income payment amount resumes when enhanced income withdrawals end. So after that 5-year period, it will revert back to the original guaranteed lifetime income payment. Enhanced income withdrawals may be put into action after your contract has been in effect for 3 years. If the contract has an accumulation value greater than 0, no additional premiums have been added in the last 2 years, and the owner is a U.S. resident not older than age 90. During the enhanced income withdrawal period, the chronic illness must be certified by a physician annually. So terminating the income benefit rider, it can be terminated upon your request, but once terminated, it cannot be restarted. It automatically terminates in the event of death of the first contract owner, unless spousal continuation is elected. Full surrender, annuitization, contract ownership change other than a spousal continuation or the addition of a spousal joint owner, and excess withdrawals that reduce the accumulation value to 0. All right, so that covers the brochure. We are now ready to delve into the software to see how the index crediting strategies stack up. And we'll also take a look at the income benefit rider calculations to give you an example of how the income grows and how it may change during each year of deferral. So Equitrust is also located in West Des Moines, Iowa. For more information, you can always go to their website at www.equitrust.com. Again, if you're looking at comparing this annuity to others, maybe you've been positioned this annuity from a sales rep of a company or an advisor of some sort, and you want to know if it's right for you and if it's the truly the best one for your given circumstances, that is exactly what we do. Here at annuityassociation.com, we help clients make better annuity buying decisions, and we do that with a very easy and simple, transparent process that provides a lot of education, but more importantly, the ability to compare and contrast this annuity across all of the others on the independent annuity marketplace. We're an independent annuity advisory firm. We don't have any allegiance or alliances to any one company or product. We truly look at this objectively to help you make a better decision. And with that, we hope that if we can earn your trust through that education, that you'll buy those annuities through our firm. And that's how we're compensated. It doesn't come out of your initial premium. You're not charged any fees from our firm at all, or the insurance company for that matter. So if you're looking to make a better annuity buying decision and you want to work with us directly, you can go to annuityassociation.com, and right there on the main page, click the green button to schedule a time to meet with us. And we'll meet with you via Zoom. We serve clients in all 50 states, and we do so utilizing Zoom as our platform of choice. So very simple stuff there. Okay, let's get into the software. So let's start with the income benefit rider first, since this is more of an annuity focused on guaranteed lifetime income. Let's go ahead and take a look. So if you choose to work with our firm, we will take you into our process of understanding by utilizing a very transparent and easy to understand software where we'll input all of your specific parameters, such as your state, your age, the premium investment amount, and whether it's a single or joint life structure. And then we'll use this deferral bar to give you an understanding of what that income would be during the different years of deferral for your planning. So if you're 60 and maybe retiring at 67, we could come all the way out to 7 years and see exactly what that amount would be on a guaranteed basis based on the income rider and how it grows during that deferral phase. So as an example, you'll see on the far right here, the parameters regarding the income rider contract. So this is referencing that 25% income benefit value bonus that's applied day one to the contract, and then that guaranteed 7% roll-up rate that's compounded each year of deferral. So in this example, we input $100,000 as a premium investment amount, and we'll see that after the 25% bonus and then 7 full years of 7% compounded interest, that $100,000 has now grown or doubled in this case to $200,723. And then based on the contractual payout percentages, you'll see that this payout percentage based on that person being 67 and structured for single life, they would pay 7.2% of that 200,000 and change. If you multiply those two together, that's where you'll get this annual figure of $14,452. You'll see that the single life structure with that enhanced income benefit rider for long-term care, that $14,452 would double in the event they qualified for that benefit. Last but not least, we're able to give you that very simple, transparent understanding of the different values based on the different years of deferral. So the withdrawal changes, withdrawal percentage changes, and how those change based on your age at the time of election, how that income base grows during each year of deferral, and then what those annual figures would be from a lifetime income perspective. One of the things that I appreciate the most is what we call the cash flow, or the income to premium ratio. And that basically is derived from, your initial investment amount and how much income you're getting for that investment amount. So in this case, if this person waited till the 8th contract year after 7 full years of deferral, the cash flow or income to premium ratio would be 14.45% on 100,000. Very cool. All right. In addition to that, if we wanted to look at real quick a joint structure, so let's say they're a married couple, they're both 60 years old, we can tell you exactly how much that income would be for those people in a joint life structure based on 7 years. And you'll see how our software then recalculates to reflect the joint lifetime payout percentage versus the single life payout percentage. And then last but not least, again, we compare and contrast and rank these companies and products according to the highest contractually guaranteed income. So if you wanted to compare this product to the others on the market, this is how we would do that. We would come in and look at how Equitrust may rank across all of the various companies on the market to help you make a better annuity buying decision. And if you're interested in doing that, you can simply visit our website to work with us directly at annuityassociation.com and request an annuity discovery meeting, where we'll delve into what's important to you and what matters most, and help you understand all of the annuities available on the market that'll help meet your objectives, and more importantly, give you a very easy way to compare them so that you can make a better annuity buying decision. All right, let's take a look at the performance analysis on this annuity for the index crediting. So in each of these indexed annuities, there's going to be a assortment of index crediting strategies, and you want to know exactly which ones are going to perform better than others. And why it's important that you make a good decision with that is because not all indexes are created equal. Some perform better than others, and not all index crediting terms are better than others. So they're not created, or not all of them are created equal. So there are some that are better than others. So in the Market 7 Index, what you're looking at here is a hypothetical historical back test using the last 10, 15, and 20-year periods if the data is available. And it's taking a look and ranking these chronologically highest to lowest based on the best performing strategies using the last 10 calendar years. These are annualized returns, so you're seeing them stacked up according to that annual return. And it's identifying the highest performing crediting strategy in this particular product. So a lot of times you'll see we see illustrations that prospective clients bring to us from other agents or advisors they're working with or have worked with in the past. And oftentimes we see that the index allocations are not appropriate. They're just kind of created out of thin air, it seems at times, where they're just putting, whatever sounded good or was the flavor of the month for that annuity at that time. And there doesn't look like there's any specific strategy that was involved to determine those index allocations or index crediting strategy choices. And so we look at this and take a really in-depth analysis and understanding of the various indices, and we create a unique index allocation strategy so that we can try to eliminate the possibility of ever getting a zero in any crediting term. The goal is to help you sustain your accumulation value as long as possible so that you have more flexibility and optionality as you move through the contract, that should your needs change in the future, should you want to take a free withdrawal, or if you pass away, that your heirs are going to have something left in the form of a death benefit. And the more strategic you are about your index allocations, the more probability there is something left in that accumulation value, therefore translating to a death benefit. So if that's a secondary objective that you define, then you need to work with an expert that can understand these indexes and these strategies available to help you make a better decision. That's what we do here. And if that's something you're looking for, visit us at annuityassociation.com and we'll take care of it for you. Okay, so that's going to round out our review for the Market 7 Index Annuity offered by Equitrust Life Insurance Company. If you have any questions or you'd like us to take a look at any other type of annuity review out there for you that we don't have yet, please leave a comment below on whatever platform you're viewing this on, and we will definitely respond and see how we can help in fulfilling that question or request. So thanks so much for watching. This is Jeremiah Conjure with annuityassociation.com. America's leading provider in independent annuity reviews. And we appreciate you watching. So thanks so much. Hope everybody has a blessed day. Take care of one another. Goodbye.